Okay, so you just got a $12,000 bonus from your job. What do? I know what I would do. The first thing I would do is buy a chicken sandwich because I love chicken sandwiches. However, even as much as I love chicken sandwiches, I'm not going to use the entire bonus to buy chicken sandwiches. Simple arithmetic tells us that if the chicken sandwich costs $4, then if I spend $12,000 on chicken sandwiches, that's 3,000 chicken sandwiches. That's way too many chicken sandwiches. If you need 3,000 chicken sandwiches, you have a problem. Instead, the financially wise thing to do is to invest your money. So let's say you've identified a basket of stocks which you would like to purchase with the bonus that you got from work. Should you invest the entire $12,000 all at once in one lump sum? Or should you space out your investments? So let's say you divided your $12,000 into 12 equal installments of $1,000 each, and you decide to make an investment of $1,000 on the first of each month for the next 12 months. Which is the most advantageous investment strategy? That's what we're going to address in this video, so stay tuned. Assalamu alaikum, my name is Rakan Kayali and welcome to Practical Islamic Finance, where we try to understand financial matters and build wealth in a way that is in line with Islamic principles. If you need halal funding and you live in the United States, then go to fundmebff.com. We offer halal funding that can be used for basically anything. So lump sum versus periodic investing, which is the most advantageous? First, let's distinguish between two market trends. The first is upwards and the second is downwards. Now, in the case of an upward market trend, so the market is going upwards over time. In this case, when you use lump sum investing, you're going to get in the market at the lowest price. And so your profit is going to be maximized at the end of the investment period. Whereas when you're periodically investing, the shares that you purchase are going to be getting increasingly expensive the more you wait to get into the market. And therefore your profit is going to be less than in the case of a lump sum investment. The opposite is true when the market is downward trending. So when it's downward trending and you use the lump sum investment technique, you're going to buy your shares at their most expensive, and when you use the periodic investment technique, you're going to buy shares while they're decreasing in price, and therefore at the end of the investment period you're going to end up with a greater number of shares, because in both cases you invested the same amount, but in the case of periodic investing you were able to purchase the shares at a ever decreasing cost. So now the question becomes, well, what is the tendency of the market? Is the tendency of the market to be upward trending or downward trending? Vanguard did a study of the market returns from 1926 all the way to 2015, and they found that 2/3 of the time the market is trending upwards, and here I'm talking about the equity markets. 2/3 of the time the lump sum investment technique is more advantageous, and then only 1/3 of the time the periodic investment technique is more advantageous. And the difference between the two in the United States is on average 2.4%. So the expected return of the lump sum investment technique is higher than the periodic investment technique because markets tend to trend upwards. Now you may be thinking, well, that settles that discussion, right? So if the expected return of the lump sum investing is higher than what it is for periodic investing, then we should always go with the lump sum investing. So this video is over. Thanks for watching. Assalamu alaikum and peace be upon you all. No, I'm just kidding. It's not that easy. In order to compare the two investment methodologies, it's not enough just to look at the expected return. You have to look at something called risk. You have to look at what is the average risk-adjusted return for the different investment methodologies, lump sum versus periodic investing. In the case of lump sum investing, you run the risk of investing at exactly the wrong time. So you make your lump sum investment and then the market drops 40%. So an example of this would be investing a lump sum in January of 2008. In 2008, the market lost 40% of its value. Now, I did the calculation of investing a lump sum in January of 2008 versus periodically investing a fixed amount of money during that same year. And here is the result of that calculation. So lump sum versus periodic investing in 2008, you see that if we go back to the example of the $12,000 bonus, in January, if you lump sum invested that $12,000, at the end of the year, so December 31st, 2008, assuming you invested in the S&P 500, I know that not all companies in the S&P 500 are halal, but just for the sake of this example, assume that you invested in the S&P 500. On December 31st, the value of your portfolio would be $7,411. On the other hand, if you had taken a periodic investing approach and you invested $1,000 at the beginning of every month for 12 months during 2008. So you started off with $1,000, that became $939 by the end of January, and then you invested an additional $1,000, that became $1,872 by the end of February, and then so on until December 31st, your portfolio value would have been $8,820. So instead of losing 38% with the lump sum investment, you lost only 26% with the periodic investing. Now, with these relatively smaller numbers, one may say, well, the difference between these two results is only $1,400. I'm still going to go with lump sum investing because the expected return from lump sum investing is higher than periodic investing, and that's perfectly reasonable. However, when you go into the larger amount, so let's say you had a pension and then that pension gave you the option when you retired of either taking one lump sum or taking periodic payments over the period of your retirement, and you decided to take the lump sum, and that lump sum, let's say, was $480,000. So this was the lump sum that you got from your pension, $480,000. Now, assuming that you invested this lump sum in January of 2008. At the end of 2008, December 31st, 2008, you lost 38%. So you're at $296,447. That's a big ouch. Now, had you periodically invested the $480,000, let's say at the rate of $40,000 every first of the month for 12 months during 2008, as opposed to lump sum investing, you would have come out of 2008 was $352,796. So the difference between these two methodologies was $56,349. So this difference is hardly trivial, it's quite substantial. And now if we assume that you kept your money invested till 2019, till today, this $56,000 that you missed out on because you lump sum invested as opposed to periodically invested would have become around $200,000 based on how the market has performed since December of 2008. So this is hardly a number to scoff at. So there are real risks associated with lump sum investing versus periodically investing. Even if the expected return of lump sum investing is on average higher than what it is with periodic investing. Remember, individuals don't experience the average. They have individual experiences that may differ greatly from the average. So just because the expected return is higher for the lump sum method doesn't mean you should always go with it. One of the questions that you should try and answer when deciding between lump sum investing and periodic investing is to ask yourself the question, what are my priorities here? Are my priorities to preserve capital? So capital preservation, is that my priority? Or is my priority to maximize my returns? If the priority is to maximize returns, then your best bet is to go with lump sum investing. On the other hand, if your priority is capital preservation and you're willing to have a smaller return, if that means taking on less risk, then the periodic investing approach is likely the more appropriate approach for you. Personally, some of the factors that may sway me in the direction of periodic investing is if the amount of investment is large. So if I have a large amount that needs to be invested, I will very rarely ever do the lump sum approach just because it helps me sleep at night, not investing all of it at the same time. And then second, I look at the time horizon of my investment. If my time horizon is really long, so for instance 10 or 20 years, then if I make an investment and it turns out to be that investment happened at the exact wrong time, I still have a lot of time for my investment to recover between now and the time where I intend to cash out of my investment position. However, if the time horizon is on the lower end, so for instance 5 years or less, then I'm going to lean towards periodic investing, because if I do end up investing at exactly the wrong time with a lump sum approach, that 5 years or less may not be enough for me to recover the investment that I made. So if you look at 2008, the amount of loss that happened was only recovered by 2013. So those two factors play a big part in swaying me one way or another in terms of whether I do a lump sum investment or I do the periodic investing and I invest equal amounts over a period of time. And here I should mention that the longer the period of time which you choose to do the periodic investing on, the more your performance is going to suffer on average when compared to the lump sum investing. So if you did that same experiment where you looked at the results from 1926 to 2015, if you extended that period of time to 36 months instead of 12 months in which the periodic investing was happening, the superiority of the lump sum investment method is now at 90% instead of 2/3 of the time. So there's really no reason, I don't think, to extend the periodic investing period beyond 12 months. Between 6 and 12 months, if you decide to go that route, is probably the right range. And periodic investing is also really handy if you are expecting that the market is going to experience a downturn. Instead of sitting on the sidelines with all of your cash and not investing anything, periodic investing is a good way to enter the market cautiously. So if you just look at the market headlines for the last 10 years, there's always been people every year that have been predicting that a recession is right around the corner. And this has caused some people to sit on the sidelines and not invest and sit with all their cash, and they missed out on one of the longest bull markets in history. Instead of doing that, if you think that maybe there's a chance that we're approaching a recession, then instead of just sitting with 100% of your cash on the sideline, periodic investing allows you to enter the market cautiously without exposing yourself to too much risk. And so if you enter the market and the market corrects immediately, then that's okay because you haven't poured all of your money into the market at once. On the other hand, if you enter the market and it continues to go up, then that's okay too, because now you're invested in the market and you're making some profit. So periodic investing is also a useful tool for people who want to be cautious about entry into the market because they see some risks that are surrounding it. So hopefully this gives you a better idea about whether periodic investing or lump sum investing is appropriate for you. In summary, there is no one-size-fits-all answer. It really depends on your specific circumstances. But hopefully the information that I provided in this video will help you make a decision for yourself. Remember, I'm not your financial advisor, although you're perfectly welcome to send me money as if I were. If you like this video, then please leave a like. And if I've earned your subscription, then thank you. As I mentioned at the beginning of this video, the goal of this channel is to understand financial matters and build wealth in a way that is in line with Islamic principles. Sometimes the video is going to be really heavy on just general finance and not as heavy on things that are specific to Islamic finance like this video was. But hopefully all of the videos are beneficial to you. If you need halal funding and you live in the United States, then go to fundmebff.com. We offer halal funding that can be used for basically anything. Until next time, take care of yourself. Assalamu alaikum and peace be upon you all.